Hello, this is Living in Colorado with your host, Brandon Metoyer, licensed real estate agent and loan officer here. Mortgage rates. What are mortgage rates doing today? And what are we expecting them to do at the end of the year? I'm glad you asked. I read your mind. I know you want the answer. Let's get into it. So let's give you some statisticals about what interest rates are doing and what the experts are projecting. Okay, do you see this? We have the weekly data, real time, October 2nd, 2025. The 30-year was 6.34%. Rate change positively increased 0.04. Your 15-year, obviously, if you have a 15-year mortgage, 5.55%. It's always better. Like, they get their money more up front. Makes sense. Rate change, that also went higher comparatively to what it was in September. Just last month, just a few days, 2 weeks, September 25th, 6.3%, and it went up to 6.34%. That doesn't truly tell you a huge indication of where we're going, what we're doing in terms of the market, but I do have that information for you. It's not on this page. I do have that information for you, and I'm here to share it because I love you. Here's the information. This is what's happening. All the latest experts of the market have explained that we're in a gradual easing over the next year and maybe potentially, most likely, over the next few years. Quick side subject, and I want to make a full video on this so you really understand. The reason why we had the 2%, the 1.9%, and if you were unlucky in 2021, you had a 3%. The reason why we had that is because when inventory was going down to the floor and we only had 1 month's worth of inventory, which we just discussed if you're watching this one in totality, we just discussed this 10 minutes ago. But if you're watching the other video, go back and watch my video that I have separated about inventory and months of supply, which I break it down. So we had 1 month's worth of inventory in 2021, which means that if sellers stopped putting their homes on the market, Colorado would have no homes for sale in 1 month. That's what that means. And yes, that is bad news. So what happens in terms of basic economics? If we have no supply and the demand is high, home prices skyrocket. And that's what we saw. We saw people flooding up and they were paying $50,000, $100,000, $200,000 over for certain houses. And they also, on top of that, what happens if you have an imbalance to that degree where you have very low supply, very high demand? What's going to get that to even out? The easy answer is raising the interest rate. Why does that work? Well, let's look at the table. If buyers are flooding because it's 2% rates, will they flood the same if it's 6% rates? Absolutely not. So if they're not flooding, this gives the inventory a chance to catch up because there's not enough buyers to just keep taking all the homes off the market. That's what would happen in a healthy market. What did we do? What did our administration do? What did the 10-year Treasury, all of them, what did they do when they saw this big gap? They lowered rates even more. So that caused a huge issue. So moving forward, as you're thinking about the end of 2025, you're thinking about your future in the housing market, and you're looking at the inventory. We have about 5 months on the market, 5 months of inventory left. Buyers' interest is still there, right? Homes are still being sold. Homes are still being bought. What would you do in the next year to make a healthy market? What would you personally do, knowing the information that you know now? What decision would you make to make sure there's a healthy market? Because everybody wants a healthy market. Of course, if you have 17 houses and you're wanting to sell them right away, of course you don't want a healthy market. But in terms of everyone winning, you want a healthy market. And the healthy market is about 6 to 7 months inventory, and we are at 5 months of inventory. How do you get from 5 to 6 or so months of inventory. That means you need time for this to come up, and you need time by either raising rates or leaving rates high like they are, because we've been sitting at about 6% for what, a year and a half now, maybe a little bit more. And when that first instituted, we had no inventory. We were still on that 2-month inventory. So that means over time, rates sitting at a 6%, 7%, that's giving sellers time to recoup and replenish inventory. We're at 5 months, and if you wanted to get to a 6 or 7, what do? Nothing. You do nothing. And then it gets to a healthy market, and then you can start playing around. So that's where we're at.